Good morning everyone and welcome to the Moneycontrol live stream. You're watching markets with Santo and CJ in association with M Stock by Mirae Asset. Well, after the stellar rally yesterday, it seems like we are in for a very muted start on Dalal Street. It looks like bulls are already tired, Santo.
Muted is an understatement. I think the
Yeah,
index is down a good
possibly.
100
Exactly.
points.
If you look at the Nifty futures on the Singapore exchange, they're indicating almost a 100-point cut on Dalal Street this morning. Largely on the back of the reversal in trade we have seen Asian stock this morning, which have given up all of their gains. That said, the Wall Street yesterday saw quite a strong trade with a lot of growth and energy stocks taking the S&P as well as the Dow Jones higher. Apart from that, crude oil prices, which have been such a headache for an economy like ours, they themselves are also hitting new lows and have now succumbed to the 1-month low at this point of time in trade, falling almost 3%. So clearly, Santo, a mixed bag of a setup for trade this morning.
Well, yes, and the rally that you had seen yesterday was largely on the back of easing of selling pressure more than any renewed buying. That clearly is not coming, and we are continuing to see sustained selling by foreign institutions also. So you could continue to see rallies. I don't think, CJ, there's going to be a market which is going to go one way down. In the past also, bear markets, if you look at it, there's constant pullbacks which keeps market guessing. And it keeps the worst part about these bear market rallies is that it keeps pulling investors back in thinking that probably now the bottom may have been tested, and that's how these things typically tend to.
Well, Santo, I think you will have to be probably psychic to be able to tell when the market is going to pull back and when the market is going to go down. But at this point of time, if you're a trader, one thing that counts is your nimbleness, how quickly you can probably go with the wind of the market. I think that is important. But if you're a longer term investor, I think probably if you have cash on your hand, that is, you probably are licking your fingers and probably are spoiled for choices. I mean, which stock to buy? I mean, you go from quality to mid cap to small cap. Almost every stock is down 10-15% on average across the board. So clearly a lot of choices, not only for longer term investors, but for traders as well.
Choices are that true, but then again, you don't know. Market was irrational till about October.
Wow.
Yes, in the sense you're getting some very crazy prices, right? So there's no reason why you can't see crazy prices on the way down also. Remember, we have still not seen the the likely disappointments in the first quarter numbers, which most people are now talking about. Analysts have been continuously trimming estimates. Most stocks you're seeing either price target or the earnings being trimmed. So maybe market is already trying to price that in, or maybe not. You could have a big shock when the numbers actually come in.
The fact that we broke below the March lows was probably an indicator that probably, yes, maybe investors are starting to price in some of the June quarter numbers as well, given that we're only, 2 or 3 weeks away from the new earnings season starting, and maybe even beyond June, maybe into the September quarter, because clearly within the analyst community, the consensus is that the first half is going to be a disappointment, but the second half could turn out to be quite good. So maybe in the next coming few weeks, once the market has priced in the disappointment of the first half, maybe we could start seeing some optimism towards the second half of the season.
Well, that said, let's take a look at some of the stocks on our watch list this morning, starting with Dr. Reddy's. Now, the company had a conference call with analysts and a flood of positive ratings on the stock all of a sudden. Now,
that happens after almost every analyst meeting I noticed with almost every stock out there. I mean, these days, every company is just giving out rosy pictures.
No, in the case of Dr. Reddy's also, the stock has been a steady performer in a volatile market so far this year. Pharma has not exactly been the flavor of the season, but the stock has managed to hold ground. Yes, it's been a big underperformer over the last couple of years, but now the price trend seems to indicate that maybe, the worst of it is already been priced in. So if you go through the analyst notes by some of the leading brokers, what they said is that the management has reiterated its guidance for 25% growth in EBITDA and return on capital employed. Also, overall, the stock is in the sense that it's moved about 20 odd percent. I beg your pardon. It's moved in a range of about 20% for throughout.
It has been a very range-bound stock.
Range-bound movement, and that again indicates that we could see the stock holding ground even from these levels.
Well, Santo, I mean, maybe it has not fallen as much as some of the other bigger cap, larger cap stocks out there, but overall also its performance has been not that great. I mean, if you look at just 2022 itself, the March quarter earnings were quite a disappointment because of one-off items, and apart from that, overall in terms of returns also has been underperforming the Nifty this year. So far. So clearly there is some concerns that investors have around the company. Apart from that, what I took out of the analyst commentary from, that investors day meeting is that a lot of analysts seemed quite buoyant about the biosimilar, entry that Dr. Reddy is trying to make and probably get its footprint into that market. Now, biosimilars have been out there for quite some time now. Of course, Biocon has made its name around biosimilars in the past 4 or 5 years. But I just feel that Dr. Reddy's is entering this market a little too late. It's almost like the way Sun Pharma was about 5 or 6 years ago when it was trying to get into specialty drugs, and a lot of people were worried that probably it's a little too late to enter that segment. Clearly, biosimilar competition is also inching up. If you look at the sort of price erosion that biosimilar drugs are seeing in US and Europe, clearly, I don't know how big the opportunity could be for Dr. Reddy's going ahead. Apart from that, even on a very, technical near-term basis, if you look at, the daily, weekly, even monthly charts, it seems like there is not much momentum to offer on the stock at this point of time. It is very likely that it might continue to consolidate at the current levels that it has been doing for quite a long time now over the past 1 year.
Well, one thing again, analysts are positive about Dr. Reddy's is that the company is committed to spend about 9 to 11% of its sales on R&D, and 1/4 of which will be on biosimilars. And despite that, the company has said that it will be able to maintain margins. Now, that's quite something. And again, one common thread through most of the reports that have come out is that the company is likely to earn a higher share of its revenues from its new businesses going forward.
Santo, I think probably, I mean, it's been a trend with pharma companies. You should always take their optimism with a pinch of salt. That is what a lot of analysts will always tell you. That said, one stock where optimism is sort of coming back again after the March quarter earnings was SRF. I mean, clearly after the surprise earnings from the company, we saw a big run up in the stock that has helped trim a lot of the losses that it was seeing earlier in the year. And the way the stock was cracking, a lot of people were concerned that probably the entire chemical story is over, given that SRF is a leader in that industry. Now, overall, if you look at the commentary that is coming out from a lot of analysts, they suggest that the demand conditions still remain quite strong, Santo, for a lot of the products that SRF is into. And clearly, that for me suggests that maybe the current levels are providing an attractive risk reward for investors, given that the correction we have seen. Overall, input prices were a concern last quarter. Clearly, margins were a big concern because of higher raw material prices. But recent crackdown on commodities and a lot of these crude oil derivatives clearly suggests that raw material prices could end up stabilizing going ahead in the coming quarters. And that could provide a little bit of a boost on the margin front. Apart from that, packaged films has been one space where SRF has done brilliantly over the past few years. And that is one area where the company is continuing to see strong demand trends. Apart from that, one thing that, this is probably a soft quality thing, but the fact that the management was able to come out and surprise, the market with its Q4 earnings and, in an environment such as the Q4, the March quarter was, I just feel that probably investors should give the benefit of doubt to the SRF management to be able to get through this year, probably, with all of its cards intact, and probably build on that base and go ahead in that growth trajectory that a lot of people feel that the company has ahead of itself.
Well, among the other chemical, if you look at the chemical packs, SRF still has been a stock which has done better than most other.
Exactly.
The correction has not been that sharp, and market has also viewed the fourth quarter performance quite positively. Just a couple of words of caution. This from Edelweiss report, which says that right now there is a bit of pressure in its packaging film margins, and that is something that it is said that probably a steep fall in the margins there, as well as in the technical textile space.
Okay.
These two segments, there could be a steep fall in margin. That is something to watch out for. But broadly, the commentary on the stock has been positive, and that's also reflecting in the stock price.
Well, I think, Santo, probably, maybe this quarter probably would be the peak of the margin concerns for me in the company. But going ahead in the September quarter, I would expect a lot of the raw material prices will start to go down, because of course we are seeing growth concerns overall across the world, and that that is moderating a lot of the commodity spike in commodity prices that we have seen. So I would be a little optimistic about September quarter. Maybe June quarter we could still see some challenges on the margin front, but I think September quarter onwards we should see some sort of uptick happening there.
Well, the whole chemical space itself will be quite interesting to watch.
Yeah.
You're seeing very diverse performance out there. You know, some of the big names have taken quite a bit of beating.
Exactly. I think this is the point where you start doing stock picking. You know, this
Exactly.
is now you can differentiate between the men's and the boys in that sector, because 2 years ago, everybody, if you were a chemicals stock, you just had to put your close your eyes and put your money in it, right? And that was the situation. But now I think investors will have to be very, very picky, understand the business, understand the market that these companies are in, and then probably go ahead with any sort of conviction in these stocks.
You know, CJ, one common thing is that almost all these companies have lined up pretty ambitious capex plans. And I'm just going through a book, Market Wizards, in which Stanley Druckenmiller had made a very interesting comment. So he says that the time to go bearish on chemical stock is the moment you see a lot of capacities going on stream.
But actually the market is treating us differently, right? Whenever a chemical company comes out with a capex plan, I mean, investors just stand up and applaud as if that is the greatest thing the company has done. So clearly there is a different way of Indian investors are reading that capex story in a very different way compared to how probably they are reading it in the US.
I would slightly differ there, CJ, because you're already seeing that most stocks have already corrected in line with the market correction. It's not that market is particularly bullish on chemicals. If you see, a lot of stocks out there are under pressure.
Yeah, that was
the ones doing well.
Margins.
Yeah, the ones doing well are very few. Now margins were under pressure. Now you have a lot of capacity also coming in. So it will be quite interesting how this this particular space plays out.
Santo, I think my last point here would be that the only thing probably why investors appreciate more capex from Indian companies is because they are not coming into a market that is already diluted. They're also coming into a market where a big player in that market, that was China, is slowly and steadily receding its feet, and they are just trying to take their position instead of already adding to the capacity that is there. I think that is the only argument why probably investors celebrate a lot of chemical capex in India compared to if it was a different scenario maybe 4 to 5 years ago.
Well, third stock, Dixon Technologies, been among the star performers during the bull run, but has been under pressure. Now Morgan Stanley has sharply cut the price target for the stock, as well as it's trimmed the earnings.
A little late to the party, don't you think?
You could probably say that. Moneycontrol Pro is also of the view that at current valuations, at about 66 times trailing 12-month earnings, the stock is looking fairly expensive and investors should wait for a better opportunity to get into the stock. Morgan Stanley's main argument here is that even at these prices, the market seems to be overlooking a lot of things. One is the pressure on margin because of rising commodity prices, and also the intense competition in the space. And let's not forget, CJ, Xiaomi, one of the major clients of Dixon Technology, is in trouble with the ED, and they account for a big chunk of Dixon's orders. Now, the company Dixon had said that it's not really facing any big issues because of that, but the market seems to think otherwise, and that's also evident in the way the stock has been performing over the last few months.
So Santo, I think clearly one thing that the management has to do going forward, and they have also indicated that they want to do, is diversify their client base. They are trying to get more top clients into their clientele so that they don't depend too much on a single client, like say for example in the way that probably a Foxconn depends on Apple for a lot of his business. So they don't want to do that, and that is something that they are clearly looking at and trying to address. Apart from that, I found it interesting that Morgan Stanley suggested that higher commodity prices could affect the ODC business of Dixon Technologies. Clearly, I feel that maybe if this view came in 2 months ago, it could have held more ground. But given the sort of downtrend that we are seeing in commodity prices across the board, from copper to zinc and whatnot, I feel that probably now these concerns have already been baked into the prices of the stock at this point of time. Apart from that, my argument would be more on the softer skills at this point of time on the company. Clearly, Dixon has shown that they have a much higher execution capacity than a lot of his rivals out there, and also the ability to scale up his operations, of course with the support of that we are seeing from government in terms of production link incentives. So I think these two factors of being able to scale up as well as strong execution will probably differentiate it from its rivals out there. Apart from that, if you look at what Axis Securities has to say, they believe that the company's net profit could grow anywhere upwards of 50% on an annualized basis over the next 2 to 3 years. So maybe that is why you're seeing the rich valuations that the stock has.
Well, on that note, the market has opened, and as expected,
it's a red tick. It's clearly
down
a red
about
tick.
close to 100 points and 1,000 gainers on the NSE compared to 757 losers. So good breadth in the mid cap, even though the front line seems to be under pressure.
I mean, now I think the mid caps are also catching up with the market, the Nifty 50. I mean, you look at the Nifty Mid Cap 100 index, it's down about 0.8%, slightly matching the downtick we are seeing on the Nifty 50. Nifty Small Cap Index also has seen about a 0.3% cut so far. So it's the small cap stocks, Santo, I think probably which are outperforming, and that is why we can see that the market breadth is still on the side of the advances at this juncture. So clearly a little bit of a mixed bag sort of an opening, but at this point of time it's a red tick on Dalal Street, and we will have to see whether this selling momentum continues or whether we could see some more bargain buying coming up, maybe some follow-up buying coming up from the market.
Well, again, it's been a very confusing trend. You have day before yesterday, you had the frontline indices standing up well, but you saw mid caps under pressure. Yesterday was again the reverse. Today again you're seeing frontline being under pressure, whereas mid caps are gaining.
I mean, probably I think the Monday's capitulation in small caps and mid caps would probably gave a lot of investors this thought process that maybe the correction maybe there is ending or nearing towards this end, and maybe from here on, if you start buying on accumulating stocks, maybe you could lose another 3, 4, 5% going ahead. But if you start accumulating here, then the upside in the next cycle, as and when it comes, would probably be the the opportunity that a lot of investors, especially those with deeper pockets out there on the HNI side, maybe some of the more well-to-do retail investors could probably be looking into those sort of opportunities. So maybe that is why we are seeing a little bit of outperformance from the small and mid caps this morning.
Well, the market breadth has just turned negative in a big way. 750 gainers and close to 1,500 losers.
Well, coming back to the stocks, Happiest Minds is the second stock on my list. Clearly, another stock where I feel that the risk reward is looking quite attractive at this point of time. After a 34% correction in the stock, I mean 34%, it was even worse probably 2 or 3 weeks ago. Recently we have seen a little bit of a comeback on the stock, on the counter. So clearly some bargain buying is coming up on that stock as well, and it is in line with a lot of what we are seeing with IT stocks in general over the past few sessions. The company, in an interview to Mint newspaper, said that they have so far not seen any sort of pullback, Santo, on the demand front. None of their clients are trying to cut their spending or cut their budgets on IT services and related services. So clearly, Happiest Minds commentary is in line with a lot of what Infosys, TCS, Wipro and SCL Tech has been telling investors and analysts actually over the past few weeks, that demand so far has not suffered, and they do not see any sort of indication that it's going to suffer going ahead. So that is something that I think the market will have to take into consideration eventually, because the market clearly was IT stocks were clearly out of favor with the market because of these recession concerns, EU concerns, geopolitical crisis in Europe. But clearly, if the demand trend continues, then market would have to readjust its thought process on IT stocks. Lastly, the company also suggested something interesting, Santo. They said that they are now building capacities and capabilities to now cater to clients in the Web3 and Metaverse segment. Now, we know that this is an upcoming space in the internet, space where Web3 apps, Web3 developer websites. You have the Metaverse, of course, taking up a lot of space right now in the mind space, a lot of technology enthusiasts out there. So clearly, the company is also looking at the future while also looking at the near term right now. And I feel that given the sort of performance trajectory that the company has given so far in its history, I just feel maybe the market would slightly start giving a relook to Happiest Mind, given the sort of correction we have seen in the valuation.
Just one point here. I think as you also said, the commentary is uniform across all companies. They're all saying that the demand is quite strong and they don't see any challenges to it so far. But this is typically the way sometimes these issues start. When you have your main market in trouble, it doesn't the demand doesn't evaporate overnight. You get to know it only over a period, and perhaps that is what the market seems to be worried about. And you're also hearing about it in some of the fund manager commentary, where they have said that if the US economy goes into a recession, there's no way that the demand can't be for IT. IT firms won't be affected at all, and that's what the market is pricing. That's one. Secondly, I think in this kind of a uncertain environment, usually investors may want to go with the larger cap names rather than the mid caps. And also remember, Happiest Mind, while it has been growing very strong, the last 5 years earning growth has been pretty robust and probably justifies the high valuations it's commanding at. Just, usually a tendency to shift to some of the less risky names whenever there are macro headwinds.
Yeah, clearly. I mean, as the large cap, if a rally has to begin in IT, clearly it will be the frontline stocks that will be leading it, and then you will see the mid and small cap, IT companies come into it, that the way we saw it in the previous cycle. But I feel that probably investors with a bigger risk appetite out there would probably look at a stock like Happiest Mind, because they can clearly, the upside that they can make will be much higher than probably they would make in a Infosys or a TCS out there.
Well, Jubilant Ingrevia is the last stock on our watch list this morning. Now, according to a note by Edelweiss, the company is trying to transition from a commodity chemicals company to one which is, into specialty chemicals. Also, the company has recently won a 2,700 crore order from a large US pharma major. Besides that, Edelweiss feels that the company has a solid network with both global pharma companies as well as major agrochemical firms globally, and the space for agrochemical intermediates is something which is growing pretty fast at this point in time, and that is where Jubilant may be really be able to capitalize on. And at the same time, its its mainline commodity chemicals business should keep the cash flows coming.
Santo, I think, yes, probably the transition that is trying to make, it is in a transition phase at this point of time as a company, because clearly the commodity chemical space is something that investors are not appreciating at all. We know why, because these are the sort of companies which face the biggest risk when you talk about competition in the chemical space and declining margins. So clearly, being a commodity chemical company is not a happy place to be in right now in the market, and that you can see in the lackluster interest that investors have in the stock at this point of time. Apart from that, somebody like the big bull Rakesh Jhunjhunwala himself has cut stake in the company quite significantly recently. His stake has come down from about 5.5% to 4.7% in the December quarter. All the March quarter, there was no change. But clearly, even he realizes that probably the upside on the stock is clearly limited, given that the company is entering a transition phase over the next couple of years. Apart from that, Santo, if you look at some of the short-term technical indicators as well, clearly the outlook there also is not very strong. So maybe one stock that I would probably sit on at this point of time and not try to delve in too much or too strong.
Well, with that, that's a wrap on Markets with Santo and CJ for this morning. Thank you for watching, and please do share your feedback on the show in the comment section below.
And as always, do follow us on the social media links at the bottom of your screen. And for rest of your financial news, stay tuned to Moneycontrol.com and the Moneycontrol app. We'll catch you again live at 3 p.m. with all the day's action. Till then, have a great trading session.